What if I used all 5 steps in this video and did this? Trading for 26 minutes and profiting 7.92%. In this video, I'll present the 5 steps in context, and then at the end, I'll show the result of how I actually did it. Welcome. Thanks for stopping by. We're going to talk in this video about big returns, trading options with a small account in 5 steps. Watch these videos that I've done before because they can help you profit targets with a higher time frame and smart money risk management for trading. It's really going to help in the context before you jump into options. I know for years, I never wanted to touch options just because it seemed very complicated. And I would say rightly so, because I didn't know how to read price correctly on a chart with the underlying instrument. And the underlying instrument that I trade is the S&P 500 micro futures. So if that's the instrument and I'm going to buy in my brokerage account a directional long call or a long put, then basically I'm taking on a trade idea risk in the form of an option to either have the direction go up, go down, but my risk is capped based on the cost of the premium. So let's get into the 5 steps. Time before price. The first thing I'm going to do is mark out my charts on sections of time in the session. What was the Asia, Europe, New York hours, highs, lows, and what was the time spent at price location during these higher time frames in these sessions? Specific session times of the day, and you really want to have for your trade model what your highest probability setups, when do they in time usually occur. That's your script, that's your model, and that's how I do it. That's what works for me, and it might work for you. Next step, price location, the key risk mitigation tool. This is one of the key things I focused on the video that I mentioned that you should watch in addition to this video, because location on a higher time frame, primarily on the daily, going back 3 days, taking a look at the weekly, then the 4 hours, very important on any kind of trade that you may put on, because you want to have context. I may only do 2 to 4 option trades a month, but I'm watching like a hawk. Price location on higher time frames. What's the current narrative? And I'm not talking a minor narrative. I'm talking the primary narrative for the year, the month, the week. Currently, as I shoot this video, we're just coming off the presidential election, and we are in the midst of a monster rally of the year and hitting all-time highs. So you need to know the story being told. Minor narratives this week are going to be the news, earnings, FOMC, economic calendar, time of the year, time of day of week, time of day. Price. I keep it real simple with price. Relative equal highs or lows in the session. So if I'm in Asia, I want to mark those price highs and lows out. I want to do it in New York. I want to do it during the London session. And then what are the higher time frame and the lower time frame price inefficiency? Fair value gaps are inefficiencies, big candle wicks on higher time frames, the middle, the 50% Fibonacci. Those are examples. So again, highs and lows, relative equals highs and lows, higher time frame, lower time frame, price is the overlay on top of the time. Next step. So my option risk is really simple. Number one is long only options. Whether it's a put or call, I'm only going long because that means my risk is defined to the cost of that contract. That put or call contract that I'm going long on, that's the max risk. The second element of the risk is the time decay risk. I'm going out on the contract for a minimum amount of time, usually 75 days to 100 days, something in between, ideally, because I'm not going to risk going in on a 1 day option or something crazy, even like a 5 day option. I know there's more money in the potential upside, but there's also, if I'm wrong, a lot more potential because of the time decay of losing my money faster. So that's it. These are the key things of how I manage risk. My duration, that's the only thing I would add to these two maxims. On my rule, I want to be out of the trade either same day and no later by the third day. If I'm not out by the third day holding a put or call, then I'll probably call a time stop on that and just get out. Whatever it is, it didn't work out fast enough. And I might shave that down to 2 days, depending on if it's really going against me. So that really caps here the 5 steps. Let's go to the example in the beginning that I talked about on my best trade of the week. Let's do that next. So the answer and conclusion of using these 5 steps combined in context of everything, of the totality, is here's what it would look like on the receipts. So limit order buy, this is the morning of November 6th, after the election result has happened for the presidential election. Limit order to buy a put executed. Here you see the price. You see the time, very important time. As I said, that's the first element, 9:31 Eastern. And then selling it, what's the time? 9:57. So you can see here, the price on the buy, the price on the sell. That's it. That is the bottom line. So that's the trade of the week. And that would be also, for educational purposes, for sure an outlier. They're not going to all be those kinds of things. This is just an ideal setup on an ideal time of day, time of week, time of year, on an election cycle, and the result in a very short time window. I had to watch it every minute that I was in it and get out because it would have gone against me if had I waited even just 2 minutes longer. It wouldn't have happened. So that's it. That's the conclusion. Thanks for watching, and stay tuned for my next video that will be coming up for the new week on where we are going with the market. Aloha and take care. Bye.